Welcome, accounting superstars. This is the place to learn accounting. Today we're going to work a little bit more with the financial statements and the accounting equation. This is the third video of a series of 3. Today we're going to find out what happens when Fred has a net loss. In the past, Fred has always had a profit. But what if he has a loss? How does that change things? So here we go. So first of all, Fred is going to invest cash into his business. So let's say that Fred invests $8,000 of cash into his business. Now, Fred does not owe this money to anyone, so it's not a liability, but we're going to put it here as equity. So $8,000. So our accounting equation balances the left-hand side on the assets, balances with the right-hand side. 8,000 and 8,000. And I'm going to label this. This is an investment. And the reason why I'm labeling it is because it helps us when we do our financial statements. So going on, Fred takes out a loan from a bank and he borrows $30,000 from the bank. So here we are, $30,000. Now Fred owes this money, he's got to pay it back, and at the same time our accounting equation needs to balance. The left-hand side needs to balance with the right-hand side. So there we go, 30,000. Let's check the totals, make sure the totals balance. So on the left we have 38,000, on the right we have 30 and 8,000, and they add up to 38,000. So it all balances. Let's say Fred does his very first job. He repairs a snowblower for somebody and he earns $200. So here we go. Now that $200, he doesn't owe that money to anybody. It's his $200, so we're going to place it under equity. 200, and we're going to call that revenue. And if you've seen prior videos, you know that revenue is money coming in from doing your job, and doing your job is really important, and Fred's job is repairing snowblowers. Now to fix that snowblower, Fred had to purchase parts, and the parts came to $150. So I'm going to write here a negative $150. And I'm going to put it under equity here, negative 150. So let's see if this balances. I have a negative 150 on the left, negative 150 on the right, so that line balances. Let's see if it all balances in the totals. 38,050 on the left, 30,000 here under liabilities, 8,050. I think if you add up the liabilities and equity, you would see it equals $38,050. So we need to label this. Using up parts to do a job, that's called an expense. An expense is money going out from doing our job, and that's not a very complete definition, but it works for us. It's good enough for now. Now Fred has a little puppy. He has a golden retriever, and he had to buy some puppy food. So Fred spent $25 on puppy food. Minus 25. Now Fred does not owe anybody for this puppy food, but he paid for it. And our accounting equation needs to balance. The left-hand side needs to equal the right-hand side. So I'll put negative $25 here. Now this is money going out, not from doing his job. His job is not to buy puppy food. Well, it is important that he buys puppy food, but it's not his job in regard to the snowblower service. So what we're going to do, we're going to call this a withdraw. All right. Now, I've seen a lot of business owners get confused with this kind of thing. This truly is a withdraw. He's taking money out, not because of doing his job, but he's taking money out for personal reasons. And a lot of business owners, a lot of small business owners, want to call that an expense, a salary, but that's incorrect. It's not. It's a withdraw. Moving on, Fred had to pay an assistant in his shop, and this assistant earned $100. So I'm going to put a negative $100, and Fred did in fact pay that money out. He does not owe it, but he paid it out. So that's a negative $100. And I'm going to call that an expense also. And the reason why, that's money going out from Fred doing the job. Well, in this case, the assistant doing the job. But it's a cost of doing business. It's a cost of operating that business. So it's an expense. So let's see if our accounting equation balances. On the left-hand side, I've got a total of $37,925. On the right-hand side, I've got $30,000 under liabilities and $7,925 under equity. And if you add those two together, the right-hand side equals $37,925. It all balances. If you've been watching any of these videos, you know these financial statements need to be done in order. First comes the income statement, then comes changes in equity, then last, the balance sheet. So let's see what we have here. Revenue. Fred only earned $200. And I can find that right here under the equity. I've got revenue here, $200. Now expenses. Fred had $150 when he bought the parts. Fred also paid an assistant, which was $100. And if you add up the parts and the assistant, that comes to $250. So minus $250. Well, check this out. It looks like the expenses were greater than the revenues. So what we'll do is we'll add it up and see what the net income is. So here we go. And the net income is a negative $50. Now this is very, very common when businesses are starting out. So this is to be expected. Let's move on to the changes in equity. The beginning equity is 0. Fred just started this business. He just got it going this month. In a later video, we'll see what happens when Fred has been operating this business for a while. You'll see it's really quite easy. Next, let's add any owner investments. Fred had an $8,000 investment, so let's put that in here, $8,000. And let's add the net income. Well, in this case, it's not a net income, it's a net loss, and it comes from the income statement. And that is why I highlighted it in yellow, so that way you can see these numbers are the same and where it comes from. We don't have to do any additional calculating. Less owner withdraws. So how much money did Fred take out of the business? Well, Fred took out of the business for personal reasons, the $25 for puppy food. So let's put that in here, negative 25. And let's find the ending owner's equity. All we have to do is add this all up and we have it. So let's sum it up. There we go, $7,925. And just in other examples, the bottom of the accounting equation here under equity here matches the changes in equity here. So that's a good way to double check your work. Lastly, the balance sheet. Let's see how to do that. Well, the balance sheet is just the accounting equation. The accounting equation right up here is assets equals liabilities plus equity. That's the accounting equation. And we know it balances. It always balances. So assets, we look at assets. Assets are $37,925. So $37,925. Coming down to the liabilities. Liabilities are $30,000. Equity is $7,925. And I've got this highlighted in blue, so that way you know where this number comes from. It comes from right over here, the ending owner's equity. All you do is transfer it over. $7,925. And let's see if it all balances. Let's add up the liabilities and equity and see if it balances. There we go. Assets, $37,925. Total liabilities and equity, $37,925. So it does balance, folks. So we know we did a good job. And if our balance sheet did not balance, all we could do, the only thing we could do, is start over and check our math. Make sure that each line balances, each horizontal line balances, and make sure that the totals balance, and then make sure that we transferred the numbers over correctly, and make sure we did our math correctly, and the same thing here, and that's the only possibility, because this balance sheet has to balance. It always balances. Now, a couple of things here that I want to bring up. The income statement. The income statement is really simple. It's about operations. How's the business operating? Revenue is money coming in from doing Fred's job. And expenses, that's money going out from Fred doing his job. And so net income is the difference between the two. And you'd like it to be positive, but this time it's negative for Fred. The changes in equity. This is a great statement, and it's actually a very simple statement. It doesn't change hardly at all. Even if you get into advanced accounting classes, it's pretty much always the same. It's the same pretty much for partnerships too. And sometimes it goes by different names. It goes by changes in stockholders' equity, changes in owner's equity, but it's all the same thing. With the changes in equity, this is a measurement of Fred's net worth in the business. So net worth, equity means the same thing. Capital, same thing. The balance sheet is one of my favorite financial statements. It helps me predict the future of the company. And the way I do that is I look at the assets. I see what kind of assets the company has, and I look at how much debt they have, because debt is like having a big weight on your shoulders, and it kind of holds you back. Although sometimes debt can be a positive thing, and it's called leverage, financial leverage, and we'll learn more about that later. So here you go, folks. I hope you liked this video. Hope it helped you out. Hope you can see that whether Fred has a net profit or a net loss, it's all the same process. It's very easy. If you like this video, hit the like button and subscribe, and let me know that you want to see more of these videos. Let me know what topics you want to see. Talk to you later, and over and out.